And that holding company would then be owned by the living trust. So ultimately, it's kind of like the Russian dolls, the Matryoshka dolls, where there's a little one inside a bigger one inside a bigger one.
Yep.
Right. That's what we're doing. We're protecting the real estate, most of all, on the innermost doll. A structure or a covering goes around that, and that's the LLC. Another LLC encompasses that. That's the holding company, perhaps, and then ultimately,
I want you to know, and I've got the T-shirt that says "Ask me how I know." Outside of my field of vision. All right, Bob. Tax reduction. What do we do?
well, tax reduction really starts with the type of entity you're setting up. And an LLC, for instance, can be taxed one of four different ways. It can be taxed as an S corporation, it can be taxed as a C corporation, or as a sole proprietorship, or as a partnership. Any one of those four methods you may choose, but each one of those comes with its own unique set of deductions and rights and privileges. You may also say obligations. So, for example, when we have an S corporation, you're going to be an employee of the LLC. You're going to have to take a salary. You're going to have to pay Social Security taxes on the active income that you receive. And so there are pluses and minuses to these choices that we want to make. And what we try to do is examine what kind of business you have and determine which type of tax method, what type of LLC structure is going to be able to give you the greatest number of tax deductions, lowering your taxes to the greatest extent. All right.
So, is this something that we need to have like a conference call with you and our CPA?
Well, I often work with CPAs frequently because the CPA is the person who knows the numbers. And if there's some reason that the numbers dictate that they ought to be structured in one way or another, then we choose that tax election. So I often consult with CPAs when somebody has one. Otherwise, if we're just getting started, we're setting up a brand new LLC for a brand new real estate investor. We'll guide them as to what the best structure is going to be from a tax standpoint.
All right. Now, what if my CPA is in another state, say Nevada, that tax hive group?
Well, that's fine. I mean, Tax Hive is a very good group. It's a good group that can advise on tax reduction. They're tax reduction specialists, and they'll do a very nice job. The key is this: they want to be able to look at every potential deduction you're entitled to take based on the way the entity is set up, and based on the facts and your business activities. And then once those two things are put together, voila, out comes a very, very good recommendation on how you can pay the least amount of tax. So Tax
Okay.
Hive is a good group.
Okay. Yeah, I just had to throw that in there because,
Hmm.
we just had tax hive not too long ago here. All right. Hey, I said I was going to save the questions for the end, but Frank Morales is on the call. He said, Roger, Bob Bloom wrote our operating agreement a few years ago. Please tell him hello for me.
Hey, good deal, Frank. Good to see you.
And the Whitbrook group says, can you explain funded? Does that mean money or property? That's a good question.
Good. Very good question. It could mean both. In other words, funding the trust. This is going back to that question about a living trust, and it has the fact that it has to be funded to be effective. First of all, let me back up a little bit. A living trust is designed to avoid probate primarily. When the estate tax exemption went to $11.58 million, most people are not going to be subject to estate taxes on a federal level. So the biggest concern is avoiding probate now with living trusts. And in order to avoid probate, the assets have to be in the trust. So in other words, if you own rental properties, you would transfer the title of those rental properties into the trust, and that is funding the trust. If you have a bank account, you would transfer the ownership of that bank account into the trust. So now the trust name or the trust rather, is the owner of that bank account. And therefore, that is what I mean by funding the trust. It could be cash, it could be stocks or securities, it could be real estate, it could be your personal residence, it could be anything of value that you don't want to have to go through probate on. Yeah, any assets left out of the trust will typically have to go through probate. And so that's what we're trying to avoid with with setting up the trust in the first place. So we want to get everything
Okay.
we own into the trust. That is funding the trust.
Yeah, I wanted to hit those questions before we got too far away from the defensive lawsuit.
Hmm.
Now we're talking about tax reduction. And I guess it's going to be like so many of the answers to what to the real estate questions that come to me are like, do you remember when Bob Dole was running against Bill Clinton for president? You might be old enough to
I
remember.
do, yes.
All right. And there was this thing in the news about Bill Clinton wearing boxers. And you remember that whole discussion of the president's
Can I
underwear?
kind of erase that
It was
image?
crazy.
Yeah,
So
yeah.
somebody asked Bob Dole, do you wear boxers or brief? He just looked at the camera and said, depends. That's terrible. That was a bad
That
joke even
is.
then. But every time somebody asks me a question, and I think my answer is, well, it just depends on the situation. I
Yeah.
think of that old joke. But a lot of the strategies that you're talking about for using for tax reduction, the answer is going to be it depends, right?
Yes, it really does.
Yeah.
It depends on a lot of things. You know what? Just as an example, we could have the exact perfect legal structure for you, but if you don't know what deductions you're entitled to, then you're likely not to take them. That's why you need a good tax group working with you to point out the deductions that you ought to be taking.
Yeah. Yeah. All right. Now, have we pretty well covered tax reduction?
Yeah, for now. Yep,
All
that's
right.
good.
Yeah, for now. All right. So, Bob, I think we're going to have you back to go deeper on this. But right now, let's go shallow on that third leg of the three-legged stool here of defense, which
Estate
was
planning, right?
estate planning.
All right. Well, as I just mentioned, that the biggest concern in estate planning for most people is avoiding probate, making sure that their loved ones are going to inherit their assets at minimal cost, minimal hassle. In other words, think of this: if you didn't wake up tomorrow morning, you probably owe creditors some money, credit card bills or whatnot, and people probably owe you money. So if we don't have a living trust, all that is going to be settled in probate. So in other words, a judge will oversee. You'll have a lawyer who's going through, what you need, balance sheets, et cetera, and they'll make sure all the money you owe gets paid out of your estate, and all the money that is owed to you is going to get paid into your estate. And then at that point, probate is closed, and your heirs can inherit from you, from the estate, what's left. Well, that's a lengthy process. Oftentimes, it involves courts and judges, and by the way, it can be expensive, and it can drag on forever. I mean, I've had one client who came to me having been in probate for 10 years, if you can imagine that, because the probate is open to challenges, litigation. So so most people would prefer to avoid probate if they only knew how, and by using a living trust, we can avoid probate. So your loved ones now get these assets within maybe hours after you pass away. There's minimal expense, if any, and best of all, everything remains completely private, because if you do go through probate, that creates a public record in the court, which is always public, and therefore, why do that? Most people would prefer to avoid probate. We use a living trust. Now, the two big tools in estate planning are a will and a trust. The big difference for our purposes is wills take you to probate, and living trusts avoid probate.
Yeah, one of the things that I think about is a will talks about what you hope happens. A trust talks about what will happen.
Very good. Great distinction.
And of course, if you go to probate, one of my students is going to find you and start sending you cards saying, "Hey, you got any real estate you want to sell?"
Yeah,
Because
yeah.
that's a big thing. Um, and yeah, all right. So what you're saying then is we're going to what are we putting into the living trust? Are we putting our LLCs and all of our companies into a living trust?
Yeah, if you're structured properly and you're not owning these assets in your name, then let's assume that the rental properties are owned by a limited liability company, which may in turn be owned by a holding company, and that holding company would then be owned by the living trust. So ultimately, it's kind of like the Russian dolls, the Matryoshka dolls, where there's a little one inside a bigger one inside a bigger one.
Yep.
Right. That's what we're doing. We're protecting the real estate, most of all, on the innermost doll. A structure or a covering goes around that, and that's the LLC. Another LLC encompasses that. That's the holding company, perhaps, and then ultimately, everything goes into the biggest covering, and that would be the living trust. So that way, at your passing, everything simply gets handed in that big box of a living trust to your survivors. So that's the ideal way to do it.
My wife and I have 5 kids between us.
Mm-hmm.
So I've thought about having different trusts set up, one for each kid. Is there any advantage to that, or is that just dumb?
No, well, you can certainly do that, and everybody's different. Every kid is different, and some kids may. Let's put it this way: we never know when we're going to pass on.
I want to leave more to my
and you never
favorite kid.
Yeah,
I'm just kidding.
You never know how old your kids are going to be when you pass on, and so if you had substantial assets and your kid's 18 years old, they're probably going to blow through the money really, really fast because they don't understand money yet. And so you could establish a trust within the trust that holds that inheritance until they reach a certain age, or you could stage it to that a certain percentage goes to the kid at age 25, another percentage goes at age 30. Ultimately, they inherit everything at age 35 or 40. But that way, you give them a chance to mature and learn the real value of money so they don't blow it. Other kids may have a substance abuse problem where it would be very irresponsible to give them all kinds of money. And therefore, the trustee would be empowered to withhold those distributions if the kid is having problems until the kid can get straightened out. So a lot of reasons why you may want to do that.
Well, we were going to have the trustee make available money for the kids if any of them wanted to go into their own entrepreneurial endeavor. If they could present a decent business plan, the trust would fund them.
Sure.
Until they turn 30 years old. But I'm sad to report that 3 of the 5 have already reached the age of 30, and the other 2 are not far behind. So, we ain't getting any younger, Bob.
All right. I'm afraid not.
So let me take a few questions from the group. I want you to know, and I've got the T-shirt that says "Ask me how I know."